Hello, hope you're keeping well. This week, we look at financial reporting and auditing from the forensic accountant's perspective. These are very important because time and again, as forensic accountants, our role will involve checking that other accountants have complied with the relevant regulations when it comes to preparing, reporting, and auditing financial statements. So we need to understand what our role will be when we take on these assignments. So we will go through our usual client screening and role acceptance procedures. But we need to bear in mind that we have to have a good grasp of the rules that relate to financial statements. In that regard, we need to remember whose responsibilities it is when it comes to preparing financial statements. Who has to prepare these accounts? Well, remember the responsibility lies with companies and limited liability partnerships, right? So you did this in your law module. However, remember human beings are the hands and the minds of bodies corporate. Okay, so even though we remember that companies have to prepare and file financial statements, we know that the officials of the company would have to execute these responsibilities. Right. So in terms of that, it is very straightforward. I hope you'll be able to go through these slides here and remember that the Companies Act and the stock exchange listing rules are relevant when we talk about responsibilities with regards to financial statements. But then the type of entity you're looking at will determine what format or what form the financial statements have to be in, isn't it? So I've given you a very good link here. If you click on the thresholds link here, it will take you through to sections of the Companies Act from the government website that gives you the various thresholds when you are trying to identify the types of entities there are. Well, that's relevant because the size of companies determine the format that their financial statements should take. So literally, we have small, medium, and large entities, if you look at it that way. And for the small entities or small companies, we can split them into two, and we can have a micro entity. Now, let me just take you there. So let's just go through this link. And when we arrive, you would see there, if we come to micro entities, these thresholds change. So you have to pay attention. Of course, when you qualify, you'll be realizing that these numbers would not be the same because as the macroeconomic variables change, the thresholds or the sizes are revised. Okay, and the typical, thresholds in determining the size of entities are the turnover or revenue, balance sheet totals, and number of employees. For those of you who did the audit module, you would have gone through this as well. So what we're saying is, if you're a micro entity, that means you're a special type of a small entity. And if you are, then you do not have to comply with all these regulations, right? And these, of course, as you know, are financial reporting standards. So these are the UK financial reporting standards. And of course, we have the International Financial Reporting Standard. Okay, so micro entities do not have that burden. Similarly, small entities are exempt, right? So they do not have to comply with the onerous burden, right? These types of regulations. Effectively, what this means is that micro and small entities are able to prepare abridged, or if you like, summary financial statements that do not contain as much information as most medium and large-sized entities would. Okay, and then we can go on and talk about medium-sized entities because they are not small. And then, of course, we can talk about large entities, and large entities will have the most burden to bear. But even there, you can also look at public entities. If you're a public listed entity, then of course you have to comply with all the reporting regulations in accordance with the International Financial Reporting Standards. So please look at that link. As I said, look at that link again and familiarize yourself with the various thresholds in terms of turnover and balance sheet total and employees. So you can see you've got the micro entity here, you've got the small, and you've got the medium size. And of course, beyond that, you're looking at other entities that are large, which or who will have to comply fully. And then of course, if you're listed, then you have to prepare your accounts in accordance with IFRSs. So coming back, when we said that the officials of the company will have to respond to whatever responsibilities there are in terms of preparing financial statements, we were referring specifically to company directors. Okay, so directors will have to ensure that these accounts are prepared. Of course, directors would usually delegate because they would not have the technical financial competence, so they would employ some accountants, or if they themselves are qualified, then they'll be able to use these rules and regulations in drafting and presenting the accounts, but they will have to sign it. So they sign it in their name. Even if the accountants prepare it, the directors are held accountable because they have to sign off the accounts. The overarching responsibility is to ensure that these accounts present a true and fair view in accordance with applicable laws. Applicable laws here being whichever regulations they've had to comply with, right? UK Financial Reporting Standards or the International Financial Reporting Standards. Okay, so these are the responsibilities. We have to know it is the responsibility of the company, and the company acts through its directors, even though the directors may rely on some accountants. After the accounts have been prepared in accordance with the financial reporting standards, some of these accounts may have to be audited. So statutory audits, again, if you look at the link that you clicked on previously, the link will tell you which company set of accounts must be audited, right? The same exemptions apply when you look at small and medium-sized entities. Okay, so you have to ensure that if a company claims to be exempt, then they must meet the threshold requirements of being small. Right? If they are small, then they are exempt. If they are not, then they have to have their accounts audited. But there are instances where no matter your size, you are not allowed to be exempt, right? So if you're public, or if you're a financial company, in the sense that you're providing any of these services, or if you're a trade union or labor relations entity, then you're not permitted to claim any exemption. Okay, so remember who can be exempt from the full set of accounts, and remember it's only small entities who can be exempt from the statutory audit. Do not be deceived, because sometimes people misunderstand what the audit is all about. So sometimes people think the person who prepares the financial statements is the same person who audits, okay, or vice versa. Sometimes people think that the auditor prepares the accounts and audits them. No, right? The auditor must be independent, and therefore the auditor is not allowed or doesn't have the right to prepare and audit the accounts. The auditor, when they come in, even though they are independent, when they come in to audit, they are not there to guarantee that the accounts are correct or perfect. The auditor is simply checking, well, I say simply, but the auditor is checking to ensure that the accounts present a true and fair view and comply with the relevant laws. So remember that, because sometimes people think it's the auditor's responsibility to check and guarantee that the accounts are correct. The auditor doesn't have the primary responsibility of detecting fraud. Okay, so the auditor is there to express an opinion, but we expect that if there are material or significant fraudulent activities going on, then that would impact on the true and fair view, and therefore it is highly probable that the auditor would find them. But the main responsibility or the main objective of the audit is not to detect fraud. If the auditor says that the accounts present a true and fair view, they are not, again, guaranteeing that the company might not fail. Remember, they are not there to really do anything other than checking that the accounts have been truthful and fair. Okay. Again, usually, if the company is almost about folding up, or if the company is going to cease operating because of significant issues in relation to performance or liquidity and so on and so forth, if there are threats to its going concern status, then we expect the auditor to have found out. But the main responsibility is not to attest or confirm or predict that the company is going to continue. Well, we are thinking about these responsibilities of auditors because, again, people sometimes have the confidence that if there are fraudulent activities, if the company is struggling to continue, they would have expected the auditor to have found out. So this is what the audit is all about. And as forensic accountants, as we said at the beginning, we are always usually looking out for accountants and auditors who have done a good job or those who haven't. Right? We may become expert witnesses, right? Checking over the work of these accountants, writing reports, and providing evidence in court to express our opinion as to whether they have met their responsibilities. And for us to be able to do that, we need to know what those responsibilities are. And I think we've laid these responsibilities out nicely, right? Knowing when and what form the financial statements should take, and knowing how the audit should be performed and what the main objective of the audit is. Good. So what do we do next? We begin to think about instances where we've taken on the role, and the commonest rule that comes up is to check to see if an auditor or an accountant has been fraudulent. Okay, so if there has been fraud in reporting or auditing, then we will be called upon. And we have to remember what the definition of fraud is. And I think we went through this the other week. So the main test is to check to see if any representation was intentionally misleading. Okay, so we're checking to see if through the accounts or through the audit, someone has said something, written something, published something with the intention to deceive. Okay, if we can confirm these two, then we will be able to express the opinion that the official or the person involved has been fraudulent. Okay, so these come about, as you can see here, where you have significant errors or mistakes that were, of course, intentional. And with that, we need to distinguish between instances where errors were inadvertently made, right? So they may be material or significant errors, but they were not made with intent. But if they were made with intent, whether they were minor or not, is not the issue. Okay, right. So you can see here that you should be looking out for these instances where people have manipulated, falsified, altered accounting records or documents from which the accounts were built. So these may be invoices, checks, bank statements, whatever. If some of the underlying accounting records have been changed to falsify or to give a different view from what the truth was, then that could lead to instances of fraud. Sometimes it's not an issue of what has been said, but what was not said, right? So if people have, withheld information intentionally, and if these pieces of information would have been material, such that people who rely on the accounts or the audit would have made different opinions, then we are talking about omissions with intent, and that could constitute fraud as well. We can also talk about instances where people have selected or applied the wrong rules or principles and thereby ended up with different numbers reported or different opinions given. Okay, so if any of these things happen with intent, then again we are talking about fraud. Good. So I think we've said it here. You can look at that, whether it was intentional or reckless misstatements in the accounts or in statements made. And the typical ones are where people are stretching the truth, the good news, so overstating revenues or understating expenses. We know why, because if you overstate revenues and understate expenses or costs, then you're likely going to end up with bigger profits. Or sometimes when people overvalue assets or choose to make errors in terms of how to recognize, depreciate, and report, say, non-current assets, right? That could lead to overstatement, and so on and so forth. So you can see all of that. You should be on the lookout for that. Also remember that people may play with timing, the timing of when events and transactions are reported. So remember the classic case of Tesco a couple of years ago. So if the recognition rules change with intent to deceive, that could also constitute fraud. So you may recognize revenue sooner or later than you should. You may recognize costs and expenses sooner than you should. You may not or may recognize contingent assets and contingent liabilities. You may play with your accruals and prepayments. Any of these that hides the truth with intent would constitute fraud. So what are the typical red flags or risk factors that you should look out for? Okay, so if you took on an assignment and you had to investigate for fraud, these are the typical things that you should look out for. And I think you can go through that, right? So things about the company characteristics, management and personnel issues, and accounting policies and practices. You will have to look at these and form an opinion as to whether it is likely that fraud may have been perpetrated. I don't want you to forget about the fraud triangle. So you can draw the fraud triangle now, can't you? So as you look at red flags, you're looking at things like opportunity, right? The opportunity side of the triangle. Is it very likely that people will have the opportunity to commit fraud in the accounts or in the audit? Again, you're thinking carefully and you're also looking at means where people may, for example, rationalize or explain things away, and so on and so forth. So what I'm saying here is, as you think about red flags and risk factors, remember your fraud triangle. You may also look beyond that, like what is happening in terms of the company's operations, right? Look out for things like what transactions are going on. Are there any unusual movements of cash and things like that? How well is the business performing? What is the general feeling like in the market, in the industry? Are there any unusual things happening? So these are also very significant. And then you come to getting the work done, where you've scoped the client and you've looked at the background issues, and then you have to get on and grab data, isn't it? Collect data, like we said last week. So you have to have had good understanding of where the likely events or the likely perpetrators of the fraud or the misstatements are, and from there you'll be able to identify the people and the types of transactions and the types of records and so on and so forth. And then you have to devise a plan, like we said last week, and identify the right people or the right documents in the right place. Sometimes you may have to go there physically, hold them, check them, verify them, call in other experts to, for example, examine documents. If you have to use some undercover surveillance or observation, you have to make sure you're doing it legally. If you have massive sets of data, you may need some data mining techniques. But simple things like your classic ratio analysis could help you to, for example, analytically identify unusual things, unusual jumps and changes and things for you to be able to focus on. So that was just to give you an overview and for you to reflect on some of the spot the error activities that we've done that centered primarily on application of accounting standards and techniques, revaluation, depreciation, and reporting, and all that. And I think that should be enough. You would have had enough guidance on how to reflect on this.